Hello active traders, this is Ken Calhoun from TradeMastery.com with the channel that's dedicated to helping you become more successful in your trades and turn things around. In this episode, you're going to be learning some strategies for trading small cap stocks, under $10 stocks for swing trades of anywhere from overnight holds up to a couple of weeks. There's a few things that I wanted to share with you from my own experience in trading these for many years with live real money trading accounts. And the first point is that there are some differences in how you look for breakout and gap continuation patterns for the stocks that are small caps, under $10 a share, compared to the ones that I typically focus on that are $20, $30, $40 a share. The number one point is that those stocks often do not continue to trend as strongly as the higher priced instruments. So there's some very careful differences that you need to look for when it looks at the underlying breakout pattern, when it comes to looking at the underlying breakout pattern for your swing trades when you're looking at the cheaper stocks. Now, one of the reasons that I'm going to be giving you some strategies for this is we're going to be launching a new swing trading small cap stock alerts advisory and training service coming up soon. So if you've got a smaller account size or you just like trading the cheaper stocks, I will be teaching you my strategies based on live real money trading experience for how that works best. But there's some nuances, some differences in how to trade those compared to other instruments out there. Okay. One of the things I also want to mention is that typically swing trading is best for $30, $40, $50 share stocks, but I realize that a lot of people out there may be new to trading and maybe only have $2,000 or $3,000 for a trading account, so you don't have the $8,000 or $10,000 or $20,000 or $30,000 that it takes for larger cap instruments to trade effectively on larger size. So if you're a student or you're retired on fixed income, or you just like to start small with a smaller account size, $1,000, $2,000, $3,000, the small cap stocks can be a good way to get started in trading as well. Another thing to notice is that a good important tip before we look at the main presentation, taken from a recent webinar I did just a few days ago, is that it's smarter to trade wide, not deep. So what I mean by that is it's smarter to trade 3 or 4 different positions or 2 or 3 positions compared to just one that you're trying to bet it all on. You want to not do that. You want to do a very small percentage of your total capital allocated to each of 2 or 3 or 4 or 5 different instruments. So you're kind of hedging your bets. And that way, if one doesn't work out, you don't worry, because the odds are one of the others may work out. Or even if 3 out of 5 don't work out, if you use really tight stops on the 3 that stop out or go sideways, which often occurs, it's kind of what I expect, is half or even slightly more of the trades may not work out from the get-go. Always smart to take tight stops on those and then build or add to the ones that do work out. And that way you can potentially not only wipe out the cost of the stops on the small ones that didn't move, but actually make money on the ones that do continue up because you're using scaling or adding to winning trades. So trade several instruments and trade carefully. Anyway, without further ado, let's take a look at a few tips in this week's episode.
Hello active traders, and welcome to our small cap swing trading event tonight, designed to help you learn new strategies for trading stocks in the $2 a share up to $10 a share price range. The 3 main takeaways for today's event that we'll be illustrating with live market charts to make it successful trades in swing trading stocks under $10. One of the most important things that is overlooked by many traders that causes them to lose a lot of money is the failure to trade consistent charts with defined uptrends. They instead try and jump onto charts that suddenly start to skyrocket up, and that's called chasing, and that'll promptly lose your money. You'll chase it up, you'll get stopped out on a pullback, and then as if it knew you were out, it'll run back up again. You get in and try and chase again, and you get stopped out again. I don't know if that sounds familiar, but that was certainly the experience I had back in my formative years trying to figure all this stuff out. And so one of the things that I came up with is the fact that we need consistency of our charts, meaning a nice 45-degree angle uptrend, some kind of a consistent day after day trend directional strength instead of something that's just an immediate pop and drop or an immediate spiker. Those are very dangerous, and they lure traders to their doom. So just say no to pop and drop cheap stocks. The other thing is trading ranges. It's really important that when you're looking for good instruments to trade, they have sufficient volatility, meaning a big enough range of at least a couple of points on a 15-day chart to be worth your while. At least a single point if it's a really cheap $2 or $3 stock. But having sufficient range is an important criteria for tonight. Swing trading stocks under $10, finding great setups, how to scan. You'll also pick up how to enter and exit your trades, how to avoid false breakouts, and how to manage risk. So enough of the PowerPoints, let's get on with the main presentation. Let's take a look, first of all, at some of the kind of charts that I like to trade, which are ones that have reasonably strong, sustainable day after day strength. Hey Stephen, how you doing? The trick is charts that have a sustainable trend that is, and this is very important, likely to inspire buying confidence from people up at new highs. So you have a nice breakout, an ascending triangle, kind of a wedge pinning up here at the top. That's all well and fine. The main thing is an experienced pro, I'm looking at the trend strength. Day over day, are we closing at new highs? And if you're closing day over day up at new highs, that's an institutional buy signal. Look at the day's closes, not just the day's highs. It's alive. We got a breakout, we got a gap, a breakout continuation, 45-degree angle breakout, we got another gap, an ascending triangle up here, and this looks really good. This guy ran from 7 to 9, which is good. Maybe worth a shot up at new highs, right? And it's a good breakaway chart. When things start to come alive and they start to make sense and they start to show directional strength, that's something you want to focus on. What else do we see? Here's one, FIT, another minor gap continuation. Now the trick about trading gap continuations for swing trading is, got all these hundreds of people leaning forward. The trick is, don't trade the day after the gap usually, because the day after the gap is usually going to be a resting or consolidation or pullback day. Instead, wait for it to break new highs and avoid false breakouts by not buying right under or right at a whole number. Use at least 10 or 20 cents above a whole number before you get in. Okay. People who went short there covering here may get a little short squeeze here, enough to trap unwary speculative longs, and then it'll continue to collapse on down. So something that's broken its trend is not good unless it takes out new highs. You see that time and time again with these charts. If we do buy bounces and pullbacks, I like to use half and whole number support and resistance areas. So for example, here's a chart in ITL. This guy ran from 7 to 9. This is a perfect example of the kind of chart that I like to swing trade for stocks under $10, right? Because it's got a sustainable trend. It pulled back the last week, so it's not good yet. If we do buy a bounce, a bounce in the pullback, I would wait till it breaks over. Again, not a trading recommendation, but 8.5 is what I'd use as resistance. So I'd want to see it climb above 8.5 and hold above there before I go long for a bounce trade. What I'd be buying is a anticipated directional trend strength continuation from what we saw earlier, right? Is make sure that we only cover instruments with lots of liquidity so that they're highly liquid and tight spreads, not these thinly traded low float crap stocks that some amateur kids are out there hawking. So does that make sense? These are the right way to trade the right kind of charts, the right way from a guy who's actually done it and figured out most of what you got to get. But still, it's a numbers game. You still got to use tight stops and play a field of instruments with good volatility and good volume and good directional explosive strength like this one, right? These type of charts make a whole lot more sense to trade than what I've seen covered out there. So I'm really excited about launching the new service. People have been asking me for years to do something in small caps or pennies. Anyway, gotta run, work to do. Thank you so much for being here. I hope that y'all have a great rest of your summer, and I look forward to seeing you in upcoming events. Take care. Goodbye.
And that'll do it for another session on small cap swing trading. I've got more videos on this topic coming up, so be sure to stay tuned. If you like what you saw, please give it a thumbs up, post comments or questions in the space below, subscribe to the channel, and until next time, trade with intelligence. Trade with real tight stops and try and make as much money as you can in your professional swing trades. So let's go get them, and I'll see you next time. Bye-bye.